Hello everyone, welcome back to the Gold Scalping Edge Trade channel. As you know, besides long-term investing, I also do short-term trading, mainly holding orders within the day, also known as day trading. However, many people mistakenly believe that day trading requires constantly monitoring charts and watching price movements all day, which leads to many risks when entering orders. In reality, I have optimized my day trading process to not consume too much time, avoiding any impact on my other work. Day trading is not something easy. It is a skill that requires practice and mastery. Our problem is how to shorten that learning curve and become proficient as soon as possible. Besides a clear roadmap, we also need an effective yet simple method that is easy to follow and apply. In this video, we will dive deep into that. As usual, if you have any questions, please rewatch the video several times and comment below so I can summarize the common topics you encounter. Let's get started right now. To understand trading, first, I will briefly recap the terms related to timeframes from high to low. First is investing. The holding period for investing is usually quite long, measured in months or years. Second is swing trading. Orders are typically held for a few days or weeks, usually on the 4-hour time frame or higher, though sometimes entry points can be found on the 1-hour chart. Day trading involves orders held and closed within the same day, usually on time frames below 1 hour. And finally, scalping. Holding times are very short, from a few minutes to several dozen minutes, usually entering orders on the 5-minute time frame or lower. Based on these factors, we can see that the advantage of day trading is holding and closing orders within the day. When we go to sleep, we no longer have to worry about the status of our orders. The next day, we start fresh, looking for new entry points. The disadvantage of day trading is that traders can easily make mistakes like overtrading or staring at charts too much, which leads to breaking discipline, entering random orders, and feeling pressured or stressed. It's not like swing trading or long-term investing where holding orders longer reduces the urge to enter new ones. Now, let's begin with a real-life case study. This is the chart for the XAU-USD pair on the 5-minute time frame from Monday, the 5th of May, 2025. Since it is Monday, we can see a small weekend gap right here. Normally, on Monday mornings, I just glance over the market situation from the previous week to grasp the overall general trend. Since I am a day trader, I usually watch the 5-minute time frame, and if necessary, I will check the 5-minute time frame for a higher perspective. On the 5-minute time frame, I can zoom out on the chart to see the big picture. On a larger picture, we can see a slight downward phase right here. That was followed by a strong bullish momentum in this area. Up to the present moment, we can see that after this strong rally, price began to move sideways and then created bearish structures that broke through the buyer's key base. Then it continued to consolidate and is now showing a further downward bias. Thus, from this overall picture, we can see that price was previously in an uptrend on this 5-minute time frame. After that, it went sideways, and in this most recent phase, there is a bearish momentum followed by consolidation, seemingly continuing a downward wave to break through this bottom. Consequently, we can see that the current price direction is leaning towards a decrease on this 5-minute chart. Looking at it this way, we only need to focus on the most recent picture, from the rally phase to the recent decline. It is not strictly necessary to focus too much on the much earlier stages. Some might even switch to the 5-minute time frame. Zoom out the chart and start overanalyzing the price action from way back. Why should we avoid doing that? Analyzing the long-term historical picture might still have some relevance to the current phase. However, at this moment, Our primary trading time frame is the 5-minute chart, whereas this is the 1 5-minute chart. This means that in the lower time frame, it is currently following the flow of the current stream. In this case, the bias is strictly bearish. That's the big picture to help you identify a downtrend. Now let's move on to part 2, where we'll dive deeper into how to spot and trade an uptrend right here.